Welcome to the Elevate Roundtable, recorded on Thursday, July 16th. It is 12:42 p.m. Eastern Time. Here we invite you behind the curtain of the investment and financial planning world, a seat at our table where seasoned professionals tackle markets, strategy, and wealth stewardship. We're a team of highly credentialed advisors sharing insights rarely heard outside the walls of an investment firm. Whether you're a client, a business owner, or simply an investor seeking wisdom and perspective, we're glad you're here. Let's dive in. Gentlemen,
What's up,
Good to,
Tom?
Good morning.
I'm gonna hit
Good to
us
see you guys.
with a little index recap. We got the S&P up about 10.5% year to date, equal weight, churning on up 11 over 11%. We got small caps up over 20% year to date with the with gold down 8% now year to date. In mid-July,
A little bit of turnover from last year, eh?
it was looking like a momentum trade, huh?
Gold? Yeah, absolutely. It was. It was.
Well, a big topic that we've been discussing internally, and I think that we should continue to have is dealing with the problem of how investors are measuring success, maybe up against a benchmark, which always happens to be the S&P 500.
Yeah, we've been discussing it, so we're gonna make a change in our reporting. We've historically just kind of thrown the S&P 500 as a benchmark and a bond index, the Bloomberg aggregate bond market index out there, and kind of based on how heavily weighted people are towards equities. Like if you're 50-50, well, you should be like kind of right in the middle of those two things. If you're more heavily weighted towards stocks, then you should, maybe be more than halfway towards the S&P 500. And we kind of just always did it that way. But what I think we found is that, even if you're a balanced to even moderately conservative investor, when you just consistently see the S&P 500 versus your portfolio, it can have a negative impact on your perception of how you're doing versus how you might be doing, if you invested on your own. And I guess there's just not a lot of people out there who would just go and put their full stack on the S&P 500. We've had a lot of accounts transfer in from other firms, and I've never seen one that was 100% S&P 500. So that's just not what it's not a relevant benchmark. And to make matters worse, I'd say over the past several years, you know, the the headline, the market cap weighted benchmark has just been crushing the equal weighted benchmark because of the heavy concentration in the top, 7 or top 10 names, however you want to look at it. So I don't know. I've written in my commentaries a whole bunch of different times. I can't remember the name of it anymore, but it's called, somebody's ruler. I know. I think I learned it from Taleb, um, in Fooled by Randomness, where he's like, if you're using a ruler that's incorrect, every time you measure something, you're getting more information about the ruler than you are about the thing you're measuring. And I think that's just absolutely true. So, um, and then, I've reviewed some proposals from other, big time financial firms, like the biggest firms in the world, and none of them use the S&P 500 as a benchmark. They all use a benchmark that is geared towards what the allocation target is, right? So if you're a 60-40 style portfolio, then they use a 60-40 benchmark. If you're a 20-80 portfolio, risk from a risk perspective, then they use like a 20-80 benchmark, which is more heavily in bonds. And I think over time, it's just easier to kind of look at and measure yourself against a benchmark that is, I don't know what the right word is, right? But more in tune with your investment style and strategy. So that's what we're going to be doing going forward. We've got some work to do internally, obviously, to update our systems, because right now I think a lot of people are without a benchmark. So we've got to go manually add those for everybody. And I think that'll have to be a team effort between probably the four of us to look at what their risk score is and what their portfolio looks like, and choosing the appropriate benchmark for that client.
If someone
Yeah.
were to transfer in just the VOO position, would you consider that person, say, risk score wasn't in yet? Would you consider that to be aggressive?
Very, very
Right.
aggressive. Yeah.
So what I feel like some people fail to make the connection on is the S&P 500 being aggressive. So someone who fills out a risk questionnaire and you realize you're really not built to take risk, but then you're comparing yourself to something that is, all things considered, relatively aggressive. And I think people outside of the financial space sort of failed to put those two together.
Yeah, I think the big one too that doesn't get accounted for is the fact that
Guys, I can't.
somebody has a portfolio and they're nearing retirement and they've got big trips planned, so they're gonna go travel the world and all these things. That involves cash or low risk investments. You can't be 100% SPY. That means that you might end up paying 20% more for your trip if the market goes down, or it goes the other way, and then you're going to go out and live a high rolling life with all the winnings. But yeah, that's not a portfolio. It's just a kind of a measure of what a stock might compare to, but not somebody's actual overall portfolio. Tom, to your point, if it transferred in, it was all VOO or SPY. It's the same thing, just different ways to buy it. But you would hope you look at the whole picture and then they have rental real estate and some other stuff that outside of that kind of balances that risk. But being all in the S&P 500, I mean, that's just a lot of risk.
Well,
Yeah, not
imagine paying somebody an advisory fee for that. No,
yeah,
not going to do that either.
Tom, we see very few risk questionnaires that come back with a score of 100 or even 90 or 95. Most of them are considerably less than that. And so, you know, somebody who had 100, maybe 100% equity, but even so, we wouldn't put it all in like that one index necessarily. The other thing I'd say that's probably relevant at this case, and our clients will recognize if they're listening. We tell people all the time, don't risk money you can't afford to lose and pursue the money you don't
Yeah.
need to make.
Yeah.
And so, many people, their portfolios do not match up with their comfort level and their ability and willingness to take risk. And so we try to make adjustments to get somebody's allocation to, number one, match up with how comfortable and willing and able they are to take risk, but also to achieve their goals, not just to swing for the fences and hoping something good happens, but if you know if your financial plan works well at a 6% rate of return, probably not a great idea to invest 100% in equities, trying to make more and risking happily ever after in the process.
Right. So a question for you is like, have you, especially recently, have you had to sort of make that point to someone who is on the low end of the risk continuum, but keeps comparing their performance to the S&P 500? And then I think a good follow-up question would be for Shane, just to cover like how we're gearing towards capturing a little bit more of that benchmark, but also doing things the Elevate way and what sort of separates us.
Well, to answer your question, I haven't, which is great because I think people understand. Like if your risk score is a 35 and you're maybe 30 to 40% equities and the balance is fixed income or cash equivalents, I don't have any clients that are expecting to match the S&P 500.
Kyle?
So I do, particularly,
Whoops.
especially with younger clients, because oftentimes they are in this position where it's like, I'm not even looking at my account. I just want this thing to grow. And if it goes down 20% or up 20%, they're just doing their thing. So it does, however, come up sometimes too with those that might be nearing retirement and they're going, hey, I want to capture this return. What's going on here? And it does go back to that conversation of what is our real goal here? I was going through a portfolio, and when you break out every investment, you have things like gold, where gold's down year to date. Is gold bad? I mean, go look at the chart. It was on a killer run and it just needs a break. So do you abandon ship because it consolidates the 1 year where the S&P 500 keeps going up? I mean, that's a hard strategy. That kind of means you're just jumping. It's like a frog jumping from one lily pad to another, and each lily pad just keeps getting taken out. So that's a lot of risk, and it's hard to do.
Yeah, that's actually a really good point because I remember Shane shared a screenshot with me of the S&P compared to gold over like a super, super, super long term period. And I was just like, why don't I just put all my money in gold? But it goes back to your point of like there's gonna be years where, certain things are not doing well and other things are doing well. And it kind of brings up the point of having a semi-decently diversified set of positions.
Yeah,
But yeah, I want to talk about how we're doing things differently now because I sort of really, me and Shane were hesitant at first because we're huge on quality stocks, which is again, you could add that to the bucket of things that, have their periods of success and not so great. But yeah, let's talk about, how we're structuring things as of recently.
Hey,
yeah,
hold on one
Tom.
second. Before you move on to that, I just want to put some numbers on it. I pulled up the chart I showed you. Since 2000, gold is, even after pulling back 8% so far year to date, gold is up 1,042% since 2000. The S&P 500 is up 593%.
Dude.
So gold has almost doubled the S&P 500 return over the past 26 years. And but what about tech stocks? Tech stocks have been up so much more. Yeah, the Nasdaq 100, and these are total return numbers, so this includes dividends. The Nasdaq 100 is up 658%. So better than the S&P 500 by a little bit, but nowhere near the return of gold. And I would say this, I mean, we've been owners of gold and in various sizes for a long time, but we increased our position materially, a couple few years ago. And from the lows 3 years ago in 2023 to the highs this year, gold was up 208%. And so far, it's pulled back 26%. So if you measure from the lows 3 years ago to today, gold is still up 118%. So yeah, I mean, like you said, the question is okay, so we're in a position that we're up a lot on, and we have a whole bunch of, in a taxable account, there's a whole bunch of capital gains in there. Do you just totally abandon gold and go for semiconductor stocks? You just abandon the hedge in your portfolio because it's performed poorly over a 5-month period, basically. Um, I obviously think the answer to that is no. And it's not as though we haven't taken profits on gold along the way, right? I mean, we've trimmed it back multiple times, um, and bought it for new clients multiple times. So depending on when clients got in with us, most of them are up a lot still on their gold position, even though if you look at the year-to-date return, you're like, oh, I'm down 8% in this position and the market's up 10, like get me out of here. And I think that's, it's part of the reason that we're going to change the way we show benchmarks on our reporting, because I just think that putting the S&P 500 on every single report, I think it causes people to make bad decisions that they wouldn't otherwise be even looking to make. So yeah, just to give some numbers to what you were saying.
Yeah, and Shane, I just thought I'd add on there. One of the most successful investments has always been real estate. And it's not because of the returns, it's because it doesn't print a number every day for people to look at. So when the real estate market pulls back, they don't just abandon ship and sell their house. They just hold on and they live their life and it goes up over time. So even though it doesn't go up as much as other assets, usually it works best because the behavioral side of people have no choice. They just hold on because it doesn't print the price every single day.
It's also good because of that leverage.
Yeah.
The leverage of the mortgage is a big factor in the return function of real estate. But yeah, it's great that it doesn't show you a price every day unless you log into Zillow and check out your Zestimate. And you're gonna go fire sell your house because it ticked down 10%? Like, probably not.
I literally wouldn't put that past my dad. That's he's such a like old retired guy. Like he has nothing better to do than just like look at the like his property value on Zillow. That's hysterical.
That's
Mr.
funny.
Damone, go for a long walk. Much better for your health. Oh my gosh. Well, I don't think the macro case for gold has changed at all. Um, I still think gold is going to continue to move up. You know, we're in the consolidation period now, like Kyle said, but the U.S. debt is not getting any smaller, and it's hard to imagine our government adopting a position of austerity where we raise taxes, we cut spending, and we right the ship. So instead of an outright default, or instead of like doing what we should have done many, many years ago, the only way out, I think, is inflation.
Fire up the printer. Yeah, I
Fire up
put
the
that in my
printing press.
commentary, right? I had the China's buying the dip in gold, you can see. And overall, the central banks are buying the dip, buying way more gold than they have historically. So the biggest buyers in the world are trying to get as much gold as they can at a fair price. And so I think that'll keep a limit on how far it can go down. But I don't know. It could always go lower than this. I'm not saying there's a bottom, but I did also mention in my commentary that I'm buying some physical gold for my safe for the first time in a while, which got delivered yesterday, I might add. So very,
Nice.
Yeah.
very pretty, shiny coins now hanging out in the safe. And I also got to put some pounds in the safe, which I've been meaning to do for a while. But when I went to Scotland, I obviously converted some cash, some dollars into pounds, which is expensive. You look at the spot rate in Bloomberg and it's like, 132
Yeah.
on the pound. You go to the money changer. Thankfully, I didn't go to the airport, but I think I got it done at 142. So I was paying like 15, no, what's that, 7%? About a 7% premium to do the exchange. But thankfully, I did a whole bunch. So I had a few bucks left over
Nice.
that I stashed in the safe. And I'm going to keep doing that. I'm going to grab some euros soon and some other probably emerging market currencies just to have on hand in case of a rainy day. So I recommend any viewers or listeners that haven't already taken some steps like that. It's probably not a terrible idea.
No, that I would say that's a bright idea. This is why we keep you around, Mr. Flurry. That's a good
Yeah.
idea.
Yep. Good to have some different currencies because if people won't take dollars, that's not going to help to have, $10,000, sitting in your safe if nobody wants them. It's
No,
monopoly money.
no. You can just take a pocket knife and shave off a little sliver of that gold coin. Or better yet, have some silver coins because the denominations are what, $55 or something an ounce now instead of 4,000.
Well, keep in mind, we have a client that is, for anybody listening that doesn't know about this, you can check out some of these shows that used to be all on the Discovery Channel where people are diving to the bottom of the Bering Sea and sucking gold up off the floor of the ocean in like freezing waters. We have a client who like was literally on the Discovery Channel
Yep,
and
doing that thing.
he does exactly that. So he brought me a vial of like raw gold, right? It's never been melted down or it's just like little tiny gold flakes
Little
and nuggets.
nuggets.
So I got an ounce of that. So hopefully I won't have to shave any of my coins down, but you can buy, you don't have to buy 1 ounce coins, right? You can buy half-ounce coins. I don't know. There might even be quarter-ounce ones, but I got some half-ounce ones, and then I got some junk silver as well, right? The
Yeah,
quarters that were minted before like 1965.
65, I think. Yeah.
Yeah. So I got a whole bag of those. But just word to the wise when you when you order precious metals, right? $1,000 worth of silver in precious metals versus $1,000 worth of gold is a very different weight.
Yeah.
You're probably not going to carry around the $1,000 worth of silver because it's very heavy, let alone 10,000 or 100,000, right? So, yeah, different weights on that dollar amount.
Hmm.
Dude, I think about people doing stuff like that, like cool stuff like that, like diving into freezing cold oceans and collecting gold. And I just think about myself rolling out of my bed and sitting at this desk for 13 hours a day.
Well,
Yeah, they
Tom, to
couldn't.
be fair, not many people actually physically go do that. They have giant vacuums that they put on the sea floor and it sucks it all up into a boat and then they process it and they see where they can whatever came out, right?
So cool.
Some gold, some silver, a crab leg, who knows?
I feel pretty happy to have some of that gold though, because I think I found out like because I asked that guy, I was like, hey, can I buy some of that from you? And he was basically like, no. If you wanted to, the premium would be much higher than the premium you pay for like a gold coin that's been minted. Because apparently
Wow.
it's hard to get your hands. It really surprised me. I was like, why?
Huh.
It's raw, unrefined. Like
Yeah.
why would I pay a higher premium for that? But apparently it's in high demand. And I mean, I only talked to the one guy, so maybe he was just screwing with me. I have no idea. But that's if you go based off on what he told me, the premium was much higher. But it makes kind of sense because, like you were saying, what are you going to do? Shave off a sliver of your gold coin to buy the loaf of bread you want? Like I can just go pour out a little bit of gold dust and so it's a lot more functional in an end of the world type scenario than a 1 ounce gold coin. So I thought that was actually pretty interesting. I'd never really considered it before. I was hoping it would be cheaper, but apparently that's not the case.
Hmm.
Anyway,
Well, you previously mentioned China and central banks trying to accumulate some gold at a fair price. When I think of things trading at fair prices, I think of quality stocks. So I think it would be a good conversation to have about maybe some opportunities here. A, a, f- a while back, I mean, a few weeks ago, a few months ago, this was completely hypothetical and not serious, but I asked Shane, like, what's stopping me from putting my entire life savings into Microsoft? And I just think the opportunity on some of these names can, like, I'm just thinking this market can make millionaires, and I'm not even talking about these insane profitless tech AI companies. Like I'm thinking about companies like Microsoft. So I want to talk about potentially some opportunities that are out there, some that we see, and then going back to the point of how we're sort of tailoring our equities portion of our models to more aligned with benchmarks and own more ETFs, how we could still take advantage of some of these names that we are looking at.
But I have two thoughts, if you would let me just say them quickly. First, Tom, not Microsoft, gold. We just went through all of
This is I should go 50-50.
you said Microsoft under 400 though, and now it trades at 402, so you missed the boat by
And
$2.
and second thing I'd say, and this is Shane is going to be, I think, the most qualified person to just have this conversation, but do us a favor for everybody and just define what you mean by quality stocks, because people hear about quality this, quality that. Most of it's meaningless, but in this context, it has a very specific meaning.
Yeah, I'll leave that
Oh,
to
quiz time for the CFA candidate.
we're looking at we're well, I mean the way that we look at it is cash compounders, free cash flow compounding, high return on equity, high return on invested capital for for semi-long periods of time. I think of at least like 5 years, but even 10, 20 years, some of these names again that we spoke about have been doing this since the day I was born or even before I was born, which is the mid 90s, insanely. That is I'll let Shane add to that, but that's what I think about when I hear quality stock.
Yeah, I mean, the primary driver for me is the first thing that I always want to see is a high return on invested capital. Ideally, a higher return on invested capital than they pay and weighted average cost of capital. That to me is how you can be sure that, the company's adding value through running its business and through its normal operations. So that's the first thing that I look for. There are some companies out there that don't actually have um, a return on equity because like McDonald's, for example, would be one of the highest returns on equity you can imagine. But when you do a search for a return on equity, you will not find one for McDonald's because they don't have any equity. It's such a high quality business that they're able to borrow tons and tons of money and pay for it with their cash flow that they've got more debt than than equity in their business. So you can't even create a return on equity percentage for a company. Like you can't divide by zero, right? Or a negative number. Returns a meaningless result. So return on invested capital is the one I like to focus on, but we look at return on equity, return on assets as well. And we want something over 15%, ideally over 20%, and it's got to be higher than the weighted average cost of capital. So that's the first thing that that's the first kind of gate you got to get through. And then beyond that, we want to see at least 10% free cash flow margin. So that means, at least 10 cents of every dollar that you generate in revenue is available to shareholders of the business. So after you pay all your operating expenses, make all your interest payments, spend money on capital expenditures, reinvesting in the business, keeping your factories running, maybe expanding a little bit, doing some research and development. We want at least 10% of that revenue left over to either buy shares back or pay dividends or do something else. So those are the two primary things that we look for. There are other things beyond that. Obviously, a higher free cash flow margin is better, but it's got to be at least 10% for us to really consider it a high quality stock. And I mean, within that, there's a little bit of wiggle room, right? If somebody's got a 50% return on equity, and for whatever reason, over the past couple of years, their free cash flow margin has only been 9% because they're heavily reinvesting for the future. Okay, I might give them a pass depending on what what it is that's leading to a slightly lower than 10% free cash flow. So we kind of normalize some things over longer periods of time. But that's really what it boils down to, is just finding really high quality businesses that earn very strong returns on their capital base, and I ideally return a lot of that free cash flow to shareholders through buybacks and dividends. So to me, that's how we at least begin to define a quality stock. And then beyond that, there's obviously a continuum of things that are more high quality than others. And I guess last thing I'll say is, we won't use just this year's return on equity or return on invested capital because those things can bounce around a lot. So we like to use an average of the past 5 years at least, where the return on either invested capital or equity is over 15%. And beyond that, even if you've averaged over 15% over the past 5 years, if you've had any single year where it was negative, we kick you out. So if 4 out of 5 years your return on invested capital was 50%, but 1 year it was -1, you're out. That's not a high quality business. It's too volatile, and you can't count on it for compounding in all years. So anyway, yeah, there's a couple of different measures that we use before we dig too deeply into any business.
Yeah, and to add to that, it's funny because I just went into my Slack bookmarks. I was looking for your elite bargain list, your
Oh yeah.
Shane's bargain list, which I didn't find, but I do have a direct message bookmarked from you because I was giving you crap about liking Fizz, Fizz, which is National Beverage Corporation. I was like, I don't know, like the numbers look okay, the valuation looks okay. You're like, okay, ROIC is consistently greater than 15%, and revenue consistently growing. Earnings per share is constantly growing. The higher the better. Free cash flow and net margin greater than 10%. No net debt and no debt or net debt to EBITDA. ROIC or ROE consistently greater than weighted average cost of capital. Higher is better. 5% is world class. Fizz is up over 30%.
Yeah.
Yeah, be careful what you
FIZZ.
ask.
I put my tail between my legs and I walked away.
And then we didn't buy the stock, by the way.
We did not.
We didn't. And it's still hanging right around that level though.
It is.
Yep. Yeah, so there's a lot of
Well,
high quality businesses out there that look like that, and their charts look a lot like FIZZ, which, a year ago it traded at 44, today it's at 32, so down 40%. A couple weeks ago it was at 27, so it was down, closer to, yeah, about 40%, I guess, at the lows. And that's the way it is. I mean, there's a lot of high quality businesses out there that are trading at a very fair price, but they have no upward momentum. So it's like, I can't. That's the last gate, right? I don't just buy things because they're high quality and cheap. I've learned that lesson. The reason we don't do that is because we have done that, and cheap gets cheaper in markets like this. And so it's got to have some sign of an uptrend developing in order for us to be interested in it. Ken, were you going to say something?
No, you actually just said it,
Oh, okay. There we
the
go.
momentum thing.
Yeah. So there's a ton of high quality. So when I run the screen, right, or the scan in Bloomberg and I find, a list of 100 names, 50 of the names they pass all the gates, they land on the list, and I look at them and their charts are just down, 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 down with no sign of a turn. And then the other 50 are all expensive, like way above any type of fair price I would ever want to pay for them. And the charts are going up. And it's like there's that window where they're both cheap, high quality, cheap, and in an uptrend. I you can't find them. You can't. They are very few and far between right now. And
It's
that's
felt
just the
like
market.
so long too.
Yeah, it's been going on for a bit. So obviously we've made some changes to our I don't know, advice maybe. Because my investment philosophy isn't going to change. Like I, and buying high quality stocks is time tested. The best investors in the world, the wealthiest people in the world, they all kind of do the same thing in varying degrees, and it's not going to change. I mean, the intrinsic value of a company always follows the evolution of earnings per share. It's just a matter of like when, right? Because it can deviate from that for a long time, long enough to make people genuinely uncomfortable about holding on to it. And I don't have that problem. I mean, partly because I'm, 43 years old and I got some time left, God willing, before I retire or leave this world. And so buying Adobe right now and just not looking at it for the next 20 years that's a thing I can do. And if it goes down by another 50%, I don't really care. Um, but a lot of people we work with don't feel that way. They can take it for as long as they can take it, and then they can't anymore. And so it's up to us, I think, as relationship managers and financial advisors, wealth managers, whatever you want to call us, to ask the right questions of people to figure out like who are they? How are they going to feel about that? Because if you ask somebody, hey, do you want to buy the kind of stocks that Warren Buffett, got wealthy on and always recommends? These high quality businesses, they're the best compounders in the world, best returns over long periods of time. If you like, I can sell that to anybody. It's not a hard thing to want to buy, right? But if they don't go up over a year or even 2 years, people will lose their patience with it and they'll want to do something else. And I mean, I can't say I blame them for that. I think it's rare. That's why the greatest investors in the world are rare, right? We can't all be above average investors. And so it's just not, everybody's not cut out for that type of investing, whether that's my investment philosophy or not. Um, so just because you work with Elevate doesn't mean you have to invest in alignment with Shane's investment philosophy, right? Kyle's investment philosophy is different than mine. Ken's is different than mine. We all like quality stocks. Don't get me wrong. These guys are, they're Kyle and Ken, you guys, you're smart guys. You know that this stuff works over long periods of time. But that doesn't mean that's how you invest 100% of your money. I mean, Kyle, you trade ES futures, right? You're trading S&P 500 futures and gold futures sometimes. And so just because you know what I know and everybody knows about Warren Buffett and how to get rich over long periods of time doesn't mean that's how you invest 100% of your money all the time. So we're perfectly capable of running multiple strategies and operating under different kind of investment policy statements. And it just turns out that I think, I've said this before, but I'll say it again to you guys. Like I think 80% of our clients would rather just be in a risk weighted index of things that more closely track what the market's doing. Even if during some periods, that leads to a little bit more volatility. I think, 80% of the year as we come to the market, we better be bullish because the market doesn't go down, but, 1 out of 3 or 4 or 5 years. So I think our bent always kind of has to be bullish. And you have to have a real good reason to be bearish. And you have to have an even better reason to bet on that bear case when the market's going up because you're going to be wrong a lot of the time. And so, that being the case, we can put together a portfolio of passively managed ETFs in the right proportions where it's not just all S&P 500. It might be some equal weight, it might be some technology, it might be some international or emerging markets, or even things focused on sectors like, healthcare is gaining momentum right now and providing relatively better returns than the market. And you can follow kind of that sector rotation wheel, and look for ways to create alpha on the upside, but still kind of more closely track the index. So, we can do that. We have always done that. We've always had passive models, purely passive models. But going forward, what I think I'm most excited about is the way that we've kind of modified our Elevate models to include ETFs as an alternative to just strictly quality stocks. As we transition people over, that doesn't mean we have to never invest in a quality stock again, right? Like, you could be in the Elevate ETF 50 model, be in perfect alignment with it, right? You have all the equity ETFs in their exact proportions. You got all the insurance stocks as an alternative for bonds in the exactly accurate proportions, all down the line. Let's say you're in perfect alignment with the model. Well, when Adobe finally starts showing us signs of an uptrend, and we all agree that, like, we're pounding the table, like, we want to buy Adobe, we want to own that, we think it's going to outperform the market from here for the next 3 or 4 or 5 years because it's down 50 or 60% from its highs, it's way undervalued, and it's breaking up through some level, and it's in an uptrend, nobody can deny that. What's to stop us from adding a 2 or 3 or 4% position to that model that was in perfect alignment with our targets? We just go put, say, 5% in Adobe and exclude it from the model. So 5% of that account's now in Adobe, and the other 95% is in alignment with our Elevate 50 or Elevate ETF 50 model. Like, we're going to be able to do things like that. So it's not that we have to completely abandon quality stocks, but I think it's more about just not having a larger part of the portfolio, right? The overwhelming majority of the portfolio that is more aligned with the benchmark indexes, to keep people kind of invested for the long term without changing back and forth between strategies. So even though that's not my personal investment philosophy, and I probably won't do that with my own accounts, doesn't mean we can't perfectly do that for all the clients who that's a better fit for.
Yeah,
Yeah,
and
go
Shane,
ahead,
I
Kyle.
think something that comes to mind that's so important is the behavioral side of it. So, whatever strategy somebody goes with, it's more about fitting it to them so that they can
Yeah.
stand it.
Yep.
If you watch the movie The Big Short, when Christian Bale, he's just telling investors, or he's not even answering the phone. He just locks up their capital, he's getting his butt kicked and drinking Pepto. Like, that's not the lifestyle we want for our clients. And in the
I
end,
don't
he
want it
made
for
a ton
me
of
either. That he looked rough during that part of that movie.
like in the end he made a lot of money, but clients are not going to be able to withstand that. Like, maybe there's a rare bird that does, but
Yeah.
you just the answer in the end is really building for the client so that they can be successful. I think it's easy to get caught up in, are we beating the index or not? But a big part of it is, does Joe have something he can hold on to and have a successful retirement or whatever goal he's pursuing?
Yep.
Yeah. Kyle,
Yeah.
Shane, I was going to say, I think it's great that not only do we have the capability to do what you just described, we have the willingness to do it because it makes the most sense. Um, you mentioned people who maybe move toward the equity ETF model, or maybe even one form of the passive models. Um, there is going to be volatility on the downside, right? You're tracking the index goes down, your account's going to move in the same direction. Um, some of our clients are fine with that, but I'd say the ones whose age starts with maybe 5 or certainly 6 or 7 or 8, probably not so much. So having the ability to have our trend following overlay on top of that, if you're going to invest in stocks, you have to accept that there's going to be some volatility, and there's going to be times where your account value is lower on this statement than it was on the last one. Um, But what we want to avoid is the big catastrophic down. And
Yeah.
so the trend following overlay on top of a quasi index type portfolio, I think will very well suit a lot of our clients.
Yeah, no, I agree. And I think, well, I think here's the biggest thing that I think we can do. I mean, aside from managing the money, better than we have and putting people in things that are right for them, is like figuring out how to identify which model is the right fit for a given client. Because you can tell them, here's how this model, here's how the Elevate Basecamp models work. They're purely passive. They just track the indexes based on your risk score. Here's the divide models. They're the same as the Basecamp models, but with a trend following overlay, which is designed to get you out when things get really bad or before things get really bad, right? And with that, you're going to sacrifice a little bit of upside because sometimes the market's going to tick down. Our momentum, our trend following overlay is going to kick in. We're going to sell, trim that position down by some amount on exactly the day that it bottoms. That's going to happen sometimes. That's just how it's going to be. The point though is if that wasn't the bottom, if that was the beginning of a major 50% 3-year drawdown and you only lost 10%, that's great. But a certain amount of the time, probably more often than not, that trend following is going to kick in and the market might dip another percent or two, but it's going to go right back up. And you will be forced to buy back those positions you sold at a slightly higher price. So you're sacrificing some upside to protect yourself against catastrophic downside. That's the whole point of it. And then you've got, the Elevate models, which are a bit more active, and you can either use, our high quality stocks for the stock component, or you can use the basket of ETFs for the stock component. So we've got a whole bunch of different varieties, and I can take an hour explaining in detail how all those work to a client so that they understand it as well as I do. And then I can say, well, which one do you want? And what's
I
the
know what they're
client
going
going
to
to say?
say.
They're going to say, well, I don't know. You tell me, what's your recommendation?
Yes.
And so I think like rather than, don't get me wrong, it's good to educate people so that they know what their options are, but they don't need to become an expert and then tell us how to invest their money. I think it's incumbent on us as advisors to get to know them so well that we have confidence to use our discretion that our clients give us to say, no, I know you, Mr. Johnson, and you belong in this portfolio or this model, right? Or this style of the models, whatever we want to call it. And so I mean, and for better or worse, right? That might be the wrong call. You might learn later that like, no, that person doesn't really like that, or they say something to you down the road where you can tell that they are more interested in closely tracking a benchmark, and you could say, hey, based on the sort of questions you're calling me with, I think you're in the wrong model design, and we're going to switch you to this other one now. And so it's a little bit of a tricky thing to do, but if we get really good at that, I think the results will be better in the long run for the people who we identify and match up with the correct portfolio management style. So that's something that I think we should focus on going forward, for certainly for all of our prospects, but for all of our existing clients too, is going back through and kind of figuring out what the right questions are to ask so that you can make the best recommendation for that individual person. And we've been doing a lot of that lately. I mean, it's been tough. I mean, it's sitting in my desk and seeing the numbers. Like I'm not, I'm not proud of how these quality stocks have done over, I don't know, the past year plus, basically. I mean, really since COVID, it's been a whole different world. Only had 1 year, 2022, where fundamentals seemed to matter at all. And then all the banks failed in early 2023, and out came the Fed to the rescue, and the low quality rally has just kind of continued on from there. So it's really been like, 5 years basically that quality hasn't been as awesome as it had been for the previous, 100 years. And I'm not willing to say that that's changed and will be perpetually different forever, But I do know that, fund flows are important. Where the money's going and it's get deposited to 401k accounts and all that kind of thing is really going to drive returns in ways that it didn't in 1940, So it's something that we definitely have to pay attention to. Um, anyway, I don't know where I was going with that, but it's not been a ton of fun in the recent performance realm, and I think we've taken every action we can to improve the results for people.
Yeah, it's awfully hard to manage money when people sell in high quality businesses like Hershey and buying the next profitless speculative AI stock.
Yeah, which it'll work for however long it works, but
And then it
in
won't.
in 50 years, I can bet that you know the kids will want a chocolate bar more than they will want whatever the current latest and greatest AI model is. Like
Right.
with a much higher degree of certainty, they will like chocolate. They will like sugar. They will
Mhm.
like salty, fatty burgers from McDonald's. Tastes aren't going to change, right? Human nature is not going to change. It's been the way it is since the beginning of time. So it'll it'll all work itself out. But in the meantime, I think, like we've been talking about, just doing what's best for the individual that we're investing for doesn't always mean buying Hershey, even though
Yeah,
that's what I want to buy.
Shane, it was kind of interesting, but I looked up the number this morning. So the question I had, and see if you guys know it, when could you buy the S&P 500 as a retail investor and just buy the index?
When were you first able to do that?
Yeah.
Mid 90s.
90s?
Tom,
I
Ken, what do you?
I'm
I wouldn't be.
thinking, but earlier than that. I'm thinking 80s.
So it
Uh,
was, I think, 1974.
Really?
really?
That's what I
Was it
looked
that long?
up. That's when
Wow.
Jack Bogle
Kyle, send
started.
me send me this recording ASAP. I just beat Shane in a question about.
What
No,
was
we
the
both went
what
over,
was
so
the
we both
ticker?
lost. It's the Price is Right rules. We both
Yeah,
Um,
lost.
right.
the
What was?
the ticker I need to look up on that one.
Oh,
But the point of why we bring that up is the US has been around for 250 years. We just celebrated that. 50 years in the investment world, if you figure everybody's investing 20, 30 years in their lifetime, that's not very long. So who knows like where it's going to go. Just buy and spy for the next 50 years might look a heck of a lot different than it did because I mean that'd be double the lifespan that it's lived so far. So
Yeah, that's a really interesting way to look at it. This whole conversation just reminded me, we're talking about the trend following overlay and the big short. And it just reminded me of I have this live news deal going on in my Thinkorswim, which is where, we have our tickers in here to look at charts and everything. And it was like talking about Datadog, um, and how over if I don't remember what year it was, but if you had bought it in 2020 and held it like smoked the S&P, and it was talking about like the power of compounding. And I was like, this was like a really nice thing to read. You don't really get messages like that, especially about individual stocks and stuff from like these larger institutions. And then I just went back and I looked. I was like what does the chart look like? And you'd have to have held it through four different 50% drawdowns. And I just think that's like I try to put myself into the shoes of people who don't do what we do for a living. And it's like I get it. Even if you had the most conviction in the whole world on that stock and you did all the research or you had inside info, like that's not everybody's cup of tea. It's tough.
when I
No,
it's
we would have got fired like 8 different times holding D-Dog. Like, yeah, because people can't, like, you just can't do it. I mean, it is so hard to play the compounding game. It just
Yeah.
it's amazing, right? And if they had done that math 3 weeks ago, the returns would have been what? I don't know, half as much, whatever they were. So
yeah,
yeah,
Right.
it's what? It's up over the past few weeks, this thing's up 172%.
Oof.
So, Tom, it's funny you bring that up. And before I get to my point here, I just want to highlight. So the ticker, it was VFINX, and it was actually 1976. It was a mutual fund
Mutual
by
fund,
the
yeah. Okay.
S&P.
Yeah, I was thinking about
But
ETFs, so yeah, I forgot about the mutual
Mutual
fund business
funds.
because it's so ancient.
yeah. Um,
True.
but then on this idea of pick your ticker, or if somebody really wants to drive themselves crazy, go look at the options contracts. So when I first started trading, I would do that. I'd go back and look and I'd be like, oh man, if I would have just held on or caught the three moves in each direction, I would be up, 2,000, 3,000%, and I'd have a really nice Ferrari. But it's not realistic. The
No.
emotional toil that takes is insane. I mean, you get a small move in the market, 1%, you could wipe out your entire account. So
Ch-
trying to sit through volatility like that or look at it in hindsight and be like, oh, if I just bought Nvidia and kept my entire net worth in there, I'd be doing so good. It's like
Right, right, right.
nobody does that.
Well, only fools do
Well,
that.
that or, a really good one is Elon Musk. He's one of the few entrepreneurs who put everything in every company and it worked for him, but there are so many others that just blew up.
Elon got everybody else to pay for stuff. He's genius at that.
He's also very good at selling stock to people in his companies. He's better at selling stock than he is at selling cars. I'll tell you that much for sure.
Well, on
Uh,
that note, we talked about SpaceX last time. Where are we? Like 136 or something?
Yeah, right at the IPO price, right
Yeah.
back to the IPO price. It broke below it a little bit yesterday for the first time, so seems like somebody's out there defending the IPO price, but it's down a bit more today, down another 2.5%. So trading 131.73 versus an IPO price of 135. If they
Ooh,
can't get it back above the IPO price, this thing could go a lot lower. I,
62, right?
well, I think that's an optimistic. Honestly, I think that's
Yeah.
optimistic. I probably wouldn't buy it there, but I could make a case for buying it there. So
Yeah. Yeah. Well, if you get back to a world where fundamentals actually matter, that stock is going a lot lower.
yeah. And fundamentals will matter. They always end up mattering in the long run. It's like Warren Buffett said, it's time is the friend of a great business and the enemy of a bad business. It's not exactly what he said, but it's close.
Yeah.
And so it's just a matter of time. And unfortunately, we could have the best portfolio in the world. If you had just held it from now to the next 10 years, you'd be up way more than doing whatever it is, the index is going to do in the interim. But, if clients get frustrated and want to move their money to another place or manage it on their own between now and the next 10 years, like that doesn't even matter you know? So just because I'm going to do something in my personal portfolio because I can handle the volatility and I don't really care if I see Adobe get cut in half from here, I'll just buy more of it. Unless something changes with the business, which so far is not showing up in the numbers. Every time they do an earnings report, they're showing growth in revenue and buying back more of their shares and generating massive free cash flow. I mean, it's not like I'm just sticking my head in the sand and not paying attention. If that stops happening, their business stops growing. Um, you know, customers start leaving and all the earnings start falling, then I will sell it. I absolutely will. But if they keep doing what they've been doing and continue to do, then I have no doubt that that business will return to a value that um, will make me a very nice return. It might be in 5 years, it might be in 10 years, it might be in 20 years. But either way, I don't personally care because I'm not going to check the value of it every day. I'm just going to read the earnings reports every quarter and keep tabs on it. As long as the business keeps humming along, then I'm going to keep probably buying it. But not everybody can do that, as we've been talking about pretty much this whole roundtable. And because of that, you know, I don't know. We got to wrap up. I think we're getting close to the time here, but when we launched Elevate, when we left Northwestern Mutual in 2017, it was partly because we couldn't do for our clients what we were doing with our own money. we had the ivory tower compliance desk saying, hey, you can't buy this. It doesn't fit our risk criteria. This municipal bond fund came off of the approved list of securities because it's showing higher volatility, but their calculation is like so wrong for that particular security. Like it was just the dumbest things in the world. And I was like, I can't do this anymore. Like, I don't think this is what's best for my clients. It's not what I do with my money. It's not what Ken does with his money. Like, we got to do something different. So we launch Elevate and we're like, hey, we can now invest our clients' money the same way that we invest our own money. Let's do that. And for the most part, that's worked out great, right? Because high quality stocks don't often go through periods like this. It's pretty infrequent. Um, but lately it's been hard. And what I've, if we stop growing as advisors and as portfolio managers, if we just rest on our laurels and stop continuously improving and educating ourselves and getting better at what we do, then I think all of our clients probably ought to fire us and find somebody else who's willing to do the work and continue getting better and better and better every year. So, yeah, I mean, in that vein, it's like, okay, so maybe investing other people's money just like we invest our own, because that's our investment philosophy, isn't necessarily the best thing to do for everyone. Even though I think it'll work out best in the long run, if we can't get to the long run, then
Right.
what does it matter? Right. And so I think that has been a modification in kind of our way of looking at things that says, hey, look, if this isn't going to work for you, let me identify the correct portfolio for you. Let's make sure we have the right models and the right trend following overlays and the right style that's going to match your personality and what you're going to be able to stick to over the long run. And let me design that portfolio for you and then put you in it and make adjustments if necessary, but hopefully not any. It's actually, it reminded me, Kyle was talking about it earlier. It reminded me of we've all heard of the golden rule, right? Jesus' famous line, treat others as you'd like to be treated. Well, I heard somebody say once that the platinum rule is treat other people how they want to be treated, right? And so there's a big difference with many people on how they want their money managed and what's going to work for them in the long run. And I think we just, as a firm, need to continue doing a better job of identifying what that is and aligning the person with the portfolio that best matches their personality.
Yeah.
So,
And Shane, real quick, can you just explain for those that don't know what an overlay is?
uh, overlay. Yes, I don't know how quickly I can do it, but it's
And
simply, overlay is a pretty basic term, right? We're putting one thing on top of another thing. So we design one passive strategy that doesn't involve any type of momentum or technical analysis. It's just a broad diversification that says, hey, I'm not going to try to manage risk. I'm going to try to diversify the risk away. That's what a passive portfolio is. It's like a tacit admission that whoever's managing that portfolio doesn't think they can manage risk. And so what they do instead of managing the risk is they buy a little tiny bit of every single thing out there and just say, hey, this is broadly diversified. The financial services industry loves to call diversification the only free lunch in finance, right? And really and you can go Google it, Warren Buffett and others have said plenty about diversification being ridiculous. I don't know, I can't remember who it was that said maybe it was oh, I can't remember his name right now. Famous writer. He said, put all, put all your eggs in one basket and watch that
That
basket
basket
very
carefully.
closely. So passive is the exact opposite of that. It's like put like a quarter of an egg in lots of different baskets, right? Just break it all up and say, I'm not going to try and get in or out or anything. I'm just going to own a little bit of everything all the time. That means the good stuff and the bad stuff, the stuff that's going up, the stuff that's going down, the stuff that's going sideways. And that works for a lot of people. It fits their personality well, and we've offered those types of portfolios. Overlaying means saying, okay, I do think I can manage risk. I do think I have an edge using technical analysis, right? We got Kyle's what is it? Are you a chartered market technician?
yeah, that's it.
CMT, right? So we have this expertise on our team. we can identify trends. We can identify, times when you have an edge on the upside or times when you have an edge that things are going down. And this is all based on probability, not certainty, right? Just because our trend following overlay triggers and we want to reduce our exposure to the S&P 500, it doesn't mean we're absolutely certain that it's going to go down. It means that given this structure and given this pattern, it is highly probable that it will continue lower. And so you reduce your exposure based on that. So that's how I would describe an overlay, is that we put a technical analysis overlay on top of our passive models, or passive investments rather. And that's the overlay. So it's overlaying one strategy on top of another and having a bit of a combination where we're kind of somewhat actively managing a passive investment strategy.
Yep, it's like adding discretion. So if it starts to look real stormy out there and we want to go in and maybe just protect the overall portfolio with kind of one move, that still remains.
Yep. All right, well, let's wrap it up. I got the British Open on over here on my other screen, just checking things out. Looks like Sanjay M is no longer in the lead at 4 under. We got somebody up there at -5. Rory's +1. And I actually have a round of golf on the calendar this afternoon, so I'm going to get moving.
Very nice. Yeah, we'll wrap it up. I just want to leave with something from Shane's commentary that I think represents why we have such conviction in the quality stocks, and that is that he says, consider that over 5-year periods, quality has outperformed 85% of the time since 1997. According to T. Rowe Price, but it was a good piece, and it stuck with me. So, just wanted to leave on that note. I believe we have our next episode scheduled for August 20th. So we will see you then. Thanks for joining us at the Elevate Roundtable. If you're a current client and want to discuss how any of today's topics apply to your specific situation, please reach out to our team. If you're a prospective client and today's conversation resonated with you, we'd love to connect. Until next time, keep elevating.
Thanks, guys.
I'll see you guys.
The following is presented for informational purposes only, and none of the information contained herein constitutes a solicitation, offer, opinion, or recommendation by Elevate Capital Advisors or any of its employees, officers, agents, or guest speakers. To buy or sell any security or to provide legal, tax, accounting, or investment advice regarding the profitability or suitability of any security or investment. Opinions and analysis are based on information from sources believed to be reliable. All investments entail a certain degree of risk, and financial instrument prices can vary and may go up or down based on any number of factors. Consult your financial professional before investing.